Hi, I'm Steve Dudash, IHT Wealth Management. Welcome to this week's Wealthcast. All right, I want to talk about the market volatility a little bit, and I want to talk about what that means to do with your cash in these situations, or infusions or sales proceeds that you may be getting in the short term. First, the volatility. It's not that surprising, guys. You know, I know earlier this week we had one of the best up days ever. Last week we had one of the worst down weeks in a decade. The point here, though, is there's a lot of programs out there called quant programs that are making most of the trades. Any given day, 90-something% of the trades that take place are actually quant programs, and that is programs that buy and sell in milliseconds, you know, based on indications. And that's fine, but the problem is other programs are following those programs. So if one is selling a stock for whatever reasons, other ones are following that program that are selling it, and then so they start selling it too. And that just increases volatility, and it works on the other way too, on the buy and the upside. It just increases the volatility a lot. So people are talking about how it's so much more volatile now. Well, get used to it, because this is just what's going to happen now, unfortunately. But this is where it applies to you. You sell a house, you inherit some money, you sell a business, you come into cash infusions from something. There's things called dollar cost averaging, and before people would do it and whatever, now I'm telling you, with this type of level of volatility, it makes it even more critical that you follow these types of steps. And really quick, what it is let's just say you get $1 million for round numbers. Instead of taking the full $1 million in cash and buying into the market that very day, instead you're going to take that $1 million and buy a little chunk of it every month. So that way, after one full year, you're fully invested in the market. And why you do that is it takes away the risk of timing. It takes away you know, if you bought in 2 months ago with that $1 million, you've lost a bunch of money just because you happened to buy in at the wrong time. If you had that same million and you were buying little pieces over a 12-month period, you're in great shape. You're actually better off when the markets go down in the beginning, because you can buy more shares every time in every given month. The point here is, guys, this is just going to be the norm. The markets are very volatile now. As long as quant programs exist, which they're always going to exist now, it's going to stay volatile. It's just the reason why, if you're inheriting money, if you have some sort of infusion of cash, you need to be more systematic than maybe people were once in the past. And I want to be clear on one other piece of this. I'm not talking about if you take money like $1 million again from your 401k and roll it into an IRA. Well, in your 401k, it was already invested in whatever you're invested in. You roll that over into an IRA, you got to stay fully invested in the market into the same types of things. You don't go and then take 12 months to invest this money. I'm talking about when you have cash on the sidelines, and now you're buying in chunks. You got to spread it out. And this is exactly when you do it. And you don't want to do it quick. You don't do it over 3 months. You know, typically you want to shoot for 12, and you can debate that one way or the other, but anything less than that, you know, you're running some risks. So keep this in mind if you run into that situation. Aside from that, have a nice holiday. New Year's is next week, so everyone be safe, have a great time, and we will talk next week. Take care.